Thursday of this week was bearish and incredibly lopsided. Therefore, it might be helpful to ask and answer, what can we learn from the latest stock market signals? Here's Thursday's session here, big gap down. After seeing this and looking at all of the data that unequivocally favored the bears on Thursday, it's very, very easy to envision something like this unfolding in the subsequent sessions. Just as this was a subtle message from the market in early April, under a bearish scenario, the market had an opportunity to roll over hard here, and it didn't. Something that we talked about in this April 6th post. Similar situation on Friday. This is a wonderfully attractive bearish setup, and instead of having something like this unfold, from the moment the futures opened on Thursday evening, instead of gapping down, they were relatively stable. And for the most part, during Friday's trading session, the tape and all of the data favored the bulls. This look here unequivocally falls into the to-be-determined category. Market participants will have more to say next week. At this point, one lopsided session with no follow-through does not negate all of the factual evidence that we've been covering since April 6th. It does help us keep an open mind about worse than expected outcomes, and it definitely tells us it's prudent to prepare for much worse than expected outcomes. Covered these charts in detail in past videos, so we'll move quickly. Trends. This is the look on June 3rd. How much damage today? Nothing particularly shocking. This is the close on Friday, June 12th, 2020. Price is still above all of the moving averages. Hard to make an argument that the look of the 50-day here is not constructive. If you examine these other bullish scenarios, not unusual for the market to come back into this area here. Simply making statements about the look of the chart on Friday, June 12th. We'll see how it unfolds next week. And we could show numerous charts that would allow us to make this argument. It's possible that this is somewhat of a retest look here, or a head fake. Similar to this head fake here in RSP relative to SPY. This was a bullish breakout and then a bearish breakdown, and this turned out to be a false bearish breakdown, which often can be extremely bullish. It's possible we could make the same argument about this look here walking forward. Once again, no predictions about next week. We're simply making statements about what we have in front of us today. Where do we stand with the breakaway momentum signal that we covered in last week's video? You may remember since 1950 there were 22 previous signals. In most cases, the drawdown was muted. In a handful of cases, the drawdown was a little bit more significant. If we put these historical drawdowns on a 2020 chart, and if we did so on the day of the signal, which was Wednesday, June 3rd, this would have been our realistic expectation chart walking forward. These drawdowns here, where my cursor is in the lower left-hand corner of the screen, all occurred in the real world if you wanted to try to capture these average and median returns on the right side of the screen. So how did this chart look as of the close on Thursday of this week? You can see the S&P 500 had somewhat of a parabolic look to it here, so it's not particularly shocking from numerous perspectives that we saw a big plunge. From a price perspective, nothing particularly shocking as of Thursday's close. The market was extended from numerous perspectives, including the equity put-call ratio. These are complacent readings here, and they told us to have realistic expectations, especially in the short term. The market always has things to be concerned about. The primary concern in the present day is probably fear of a second wave relative to the virus. As we've noted on Twitter previously, the state of Georgia began opening their economy on April 24th. That was 49 calendar days ago as of Thursday. The day the state of Georgia started to reopen its economy, it had 4,322 people hospitalized in the state due to the virus. If we fast forward several weeks later to June 11th, the 4,322 has dropped to 842. In recent days, this number has been oscillating from roughly the low 800s to about 850-ish. This is recent virus data for 4 states where some of the data has been concerning in recent days. Note, the data is between June 9th and June 10th. Data as of Wednesday, June 10th, there were 817 people hospitalized in the state of Georgia. If we compare the data on the previous page to each state's population, we can see we have a relatively small percentage of the population that is currently hospitalized due to the virus. We can debate the virus until we're blue in the face. It really doesn't matter. In the world of investing, and that's our perspective, how all of this could potentially impact the markets. The only interpretation of this data that matters is the market's interpretation. In recent days, the market's been concerned. We'll see how the data and the market's reaction evolves in the days, weeks, and months ahead. It's a tweet from Thursday's session. You can find it in our Twitter feed. The NASDAQ 100 recently spent 46 consecutive trading days above its 20-day exponential moving average. That's potentially concerning in the short term. Why? It can be a sign of an overbought or overextended market. As noted on Twitter, the exact same thing happened after a major low in 1998, above the 20-day moving average for 46 trading days. After that, the NASDAQ 100 tacked on an additional 171%. Point of the exercise right over here on the right side of your screen. This tweet covers the 1998 case. Something very similar happened after the major low in 2009. The NASDAQ 100 traded above its 20-day moving average for 43 consecutive trading days. After that, it tacked on an additional 49.22%. And in order to capture that 49.22% return, you had to endure 100% normal and to be expected volatility between point A and point B. So now we've covered the 1998 case after a major low, 2009 case after a major low, similar situation in the 2016 case. S&P 500 makes a major low in early to mid-February 2016. The NASDAQ 100 trades above its 20-day moving average for 46 consecutive trading days. Walking forward from trading day 46, the NASDAQ 100 tacked on an additional 54.66%. However, it wasn't necessarily a walk in the park after trading day 46. We experienced 100% normal and to be expected volatility, reminding us the importance of maintaining realistic expectations about how markets operate in the real world, even under bullish scenarios. As we walk through all of the latest signals and present-day charts, just keep in mind, this is not simply lines on a graph. Charts are a reflection of human behavior. In every chart that we cover in the remaining portion of the video, ask yourself, does it align with or contradict all of the information that we've been covering in recent videos? And also keep in mind, what can we learn relative to the change in the charts, what we can see in front of us since the March 23rd low? Chart dated June 10th. Highest reading ever relative to the data set in front of you, NASDAQ stocks above their 20-day exponential moving average. We could have said the exact same thing at this point right here in 2013. This is what happened in the S&P 500 after that. We could have said this is one of the highest readings ever. This is one of the highest readings ever. What happened walking forward longer term? good things. Similar situation here. One of the highest readings ever. Walking forward, good things happened. Potentially concerning in the short term? Absolutely, positively, yes. History tells us, though, it's not necessarily concerning looking out weeks, months, and years. Top portion of this chart is a daily chart. It's a ratio, physical gold relative to the S&P 500. Center portion is the 55-day rate of change of the ratio shown above. It's 55 days because at this point it had been 55 days since the recent low. And this is the S&P 500 on the bottom portion of the screen. You can see it's relatively rare for the rate of change to be way up here and then drop all the way down to the lower blue line. It's only happened a handful of times dating back to 1982. One was near the major low in 1982, a major stock market low. Second case was after the 1987 crash. This case here occurred after the major low in the S&P 500 in 2009. This case here right before an incredibly strong trend here. This is a full calendar year and into another calendar year. Something very, very similar just happened in the present day, which simply speaks to the probability of good things happening in the S&P 500 relative to the probability of bad things happening, which is something that is significantly different from a certainty or a forecast. Since this is extremely rare, it's only happened 4 previous times dating back to 1982, might be helpful to know how the S&P 500 performs specifically walking forward from these points. The answer is, from a longer-term perspective, extremely well. 100% of the cases higher 1 year later, 2 years later, 3 years later, 4 years later, and 5 years later, which aligns with a common theme that we've covered in recent weeks, talked about over and over again. Based on the data that we have in hand today, it's possible to shift our focus to a longer-term perspective, as long as we have realistic expectations about 100% normal and to be expected volatility. In this case, the market was volatile looking out 2 weeks to 6 months. To capture these returns, you had to be cool, calm, and collected in here. How about maximum drawdowns in these cases? In 2 cases, there was no drawdown. The 2 cases here, a relatively muted drawdown, 4.43% and 3.22%. We have a ton of breadth indicators that are way overextended. That can be true, but it's not necessarily a bad thing. NYSE Breadth Momentum Oscillator, 1981 to 2020. It's pretty rare to get way up here. In fact, it's only happened a handful of times. If you know your market history, these are excellent entry points from a longer-term perspective. 1982, 1984, 1991, 2003, 2009 after the major low, 2012 right before a very strong trend, 2016 right before a strong trend, and 2019. And once again, in the present day, the chart is dated June 10th. Chart on the right side of the screen comes from Cross Border Capital. Here is their Twitter handle where my cursor is on the left side of the screen. The red line is global liquidity. Think central banks pumping money into the system. The yellow line is world financial assets. In 1984, you can see the red line had a similar and rare spike. Similar and rare spike in the present day. This is what happened to global asset prices in the 1984 case. This chart comes from Bloomberg. Fastest money supply growth on record. Chart goes all the way back to 1960. This speaks to the concept of don't fight the Fed and don't fight global central banks. This is a chart that we marked up weeks ago. Basically, under bullish scenarios, we would prefer to see this indicator get above these blue lines here. See here in January of 2009, we were not able to get into the green box. We were able to get into the green box after the major low was in place. We recently entered the green box. NYSE Technical Index Weekly, 2009. You can see we dropped below the lower Bollinger Band and then recapture the center line. Similar look here, 2011. Similar look here in 2016 and 2019. Something very, very similar just happened in 2020. All things being equal, we would prefer a look like this after a look like this. Very, very similar concepts here. Drops below the lower Bollinger Band, 2009, recaptures it. Similar situation, 2011, 2012, 2016, 2019. Does it always work? Not necessarily. S&P 500 stocks above their 200-day exponential moving average. We have data going back to roughly the year 2000. Only 2 previous times, that's it, have we moved from the red box to the green box. 2003, this is the S&P 500. 2009, this is the S&P 500. Third instance in the last 20 years just occurred in 2020. Maybe not particularly shocking in the context of this chart and this chart. Dow Diffusion Index. We covered this index a few weeks ago in our weekly video. Here's a little blurb about the indicator. It's a breadth indicator tied to the 50-day moving average on the Dow. A move like this, you can say this is rarely oversold. Getting all the way back here has only happened 3 previous times. We have data going back to 2008. Happened in 2009 after the major low. 2012 after the major low and after the retest. 2011. In 2016 after the major low and after the retest. Right here. Here's the first low. Here's the second low. And then again in the present day. And if you know your market history, you know in each one of these historical cases, good things happen for a long period of time. And of course, if we look at these lines, there was 100% normal and to be expected volatility along the way. Bottom portion of your screen shows the 11-week rate of change. It's been 11 weeks since the S&P 500 printed the major low on March 23rd. This is the 11-week rate of change for the Ridex ratio of bearish funds to bullish funds. You can see there's only a handful of times where we went from the upper blue line to the lower line. 1998, 2003, 2010 after the flash crash, 2016, and 2020. Every single one of these cases is near a major low in the S&P 500. And in every single one of these cases, for the most part, good things happen walking forward with plenty of volatility between every point A and point B. Top portion of your screen, NYSE McClellan Volume Oscillator. Description of the indicator on the bottom of the screen. This is the S&P 500 for reference purposes. Extended here in a way that's only happened a handful of times. 1974, 1982, 2009, and 2020. If you know your market history, a major low in 1974, a major low before a secular bull market in 1982, and a major low on March 9th of 2009 after the financial crisis bear market. You may say, Chris, I don't like the volume oscillator. Well, we have something for you too. The NYSE McClellan Oscillator. Very, very similar concepts. This is the ratio adjusted version. Hit this upper green line here in 82 and 84. 2004, 2008, 2009. The second time is after the major low. We've hit it twice here. Hit the same line in 2016 after the low and after the retest. and hit it in 2019 after the Christmas Eve 2018 low. If you know your market history, all of these cases, including 2004, from a longer-term perspective in the S&P 500, it was all constructive. We have a lot of breadth indicators that are extended in an odd way. That may seem bad. History says not necessarily so. NYSE breadth thrust indicator, 1980 to 2020. Only a handful of times, 2009, 2011, and 2016, and the present day, has this breadth thrust indicator reached these levels. If we move down here, this is near a major low, near a major low, near a major low, and near a major low. Simply telling us to keep an open mind about better than expected outcomes from a longer term perspective. It's a daily chart of the NYSE declining issues tricks, 1981 on the left side of your screen all the way to the present day. Relatively rare, only happened a handful of times that this indicator would get this low. 1982, 1988, 1991, 2009, twice. The second one happens after the major low. 2016 here, 2019 here, and then 2020. If you know your market history, these are all constructive periods walking forward from a longer term perspective. NASDAQ stocks above the 50-day exponential moving average only have data going back to 2002. The only times we've seen a move from the lower line to the upper line. 2009 after the major low. 2012 after a major low and retest in 2011. 2016 after a low in 2015 and a lower low in 2016, and after the major low in 2019. The model uses a weight of the evidence approach, hence why we are covering so many data sets. If they're all saying the same thing, that speaks to probabilities. Very rare to see a move like this from the blue box to the green box in S&P 500 stocks above their 50-day exponential moving average. The only other times that it's happened in this entire data set, we have data going back to 1999, was right here, 2003 after the major low, and 2009 after a major low in the stock market. The third time, 2020. In the previous cases, good things happen for a long period of time, with plenty of volatility between point A and point B. NYSE stocks above their 50-day exponential moving average. Very, very rare to get all the way up here. Happened in 2003, happened in 2009, 2012, 2013, and again in 2020. Also note, the 12-week rate of change, this gigantic spike here. The only similar gigantic spike right here. And then after that, the indicator got up here. And that's where we are in the present day. NYSE bullish percent index, highest reading ever, maybe sounds scary and overbought. This is where it occurred here in 2009. Currently have the second highest reading as of the close on June 10th of 2020. No other time have we been up here with the exception of this period in here. The yield on the S&P 500 index weekly going back to 1950. 11 weeks since the major low in the stock market. Very rare for the 11-week rate of change to move from up here to down here. Only happened a handful of times. Here to here, here to here, here to here, and here to here. 1962, 1974, 1988, 2009. If we examine data going back to 1950, a move like this, these are the only cases. Therefore, it might be helpful to know, how did the stock market perform? From this point here roughly, this point here roughly, this point here roughly, and this point here roughly, which is similar to this point here. The answer? If you were patient and endured a lot of volatility along the way, the answer is the market in each case performed extremely well. It's also interesting to note, if we look at this period here, and this period here, which is based on something that just happened on the chart of the S&P 500 yield, those same basic periods were in our analysis from last week relative to the 10-day breakaway momentum thrust. Early 1975, 2009, this is July, late 1962. In each one of these cases, the drawdown walking forward was relatively muted, and S&P 500 performance walking forward was extremely satisfying in all three cases. Way to the evidence approach, NYSE common stock, breadth, momentum, oscillator. These are the only times we've seen a move from here to here. After the major low in 2009, after the low in 2011, after the major low in 2016, and after the major low in 2018. If you look closely at the chart of the S&P 500, it was not necessarily a cakewalk. 100% normal and to be expected volatility around these signal points. NYSE stocks above their 150-day moving average. We have data going back to 2002. A move like this that just occurred in the present day, this chart is dated June 11th, has only occurred in 03, 09, 12, and 2016. How did the S&P 500 perform in each case walking forward? And remember, these are the only times that this has occurred, dating back to 2002. The answer is the market performed extremely well. After this signal, the market was higher in each case, 2 weeks to 5 years from the date of the signal. It is noteworthy, if you look at these median figures here, the median progress is nothing to really write home about over the next 6 months, telling us to keep an open mind about a wide range of outcomes, including givebacks and 100% normal and to be expected. The market needs to consolidate its gains, price action over the next 6 months. And remember from last week's video, we said it's very, very easy to look at these drawdowns here in this table and just assume that the market is not going to experience a double-digit drawdown. And we said that basically would be a mistake. It is noteworthy. We have covered the 1974 case numerous times over the past several weeks or maybe even months now. And notice the 1974 case, which does have a lot of similarities to the present day, is the only one that experienced a double-digit drawdown, telling us to keep an open mind about a wide range of outcomes. If we put that 1974 historical drawdown on the present day chart, it tells us historically it wouldn't be shocking if the S&P 500 dropped below 2,800. This is 2791. That's using the date of the signal as your reference point. Historically, to capture these returns here, you had to endure drawdowns. And in one case, almost an 11% drawdown. And that's what that would look like in the present day, hypothetically. We all know that markets don't go straight up, and we all know that even under the most bullish circumstances, and within the context of extremely strong bullish trends, that the market always has normal pullbacks and corrections. SPY relative to TLT. This is the close on Friday, June 12th. What does this say about the net aggregate opinion of all market participants regarding all subjects on all time frames? TLT long-term treasury bonds relative to the NASDAQ 100. This looks like a bullish breakout favoring bonds. Now it looks like a failed bullish breakout. Close Friday, June 12th. Is it possible that the S&P 500 will trade down into this area here? Absolutely, positively, yet, but it has not yet. This also somewhat looks like a retest look. We still closed on Friday above all three of the major retracements. Small caps, SCHA relative to SPY. Not a lot of damage on this chart here, at least yet. Higher yielding junk bonds relative to TLT, lower left-hand corner. This also looks like a bullish breakout, and so far it looks like a retest. Dow, this looks like a bearish breakdown of this bullish breakout. Now you can make an argument that it looks like possibly a successful retest. We'll learn something either way in the coming days and weeks. No forecasting, no predictions. If market participants believed that a second wave of the virus had already started, and they believed that the economy was in big trouble, is it logical that SP low volatility here relative to SPY would look like this after the close on Friday, June 12th? Is it possible the look of this chart will change? Yes, it's possible. It hasn't changed yet. Similar situation here. Airline index, bullish breakout. This looks like a retest as of Friday's close. Same message here. Airlines relative to the S&P 500 outperformed by 9.84% on Friday. And even if the market backtracks further, this is Friday's close here, these lines here fall under the normal and potentially to be expected retracement levels based on the signal that we received last week. Every chart that we've covered in this week's video helps us assess the probability of good things happening relative to the probability of bad things happening. The probability of bad things happening is never, ever zero. Everything we covered and talked about in this week's video is based on the facts that we have in hand today. If the facts change in a material manner in the coming weeks, we have to reassess the probabilities. And we know the only way that we can do that is to head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.